Rajeev de Mello is head of Asian investments at Western Asset Management, which is one of the world's largest fixed income managers and also a unit of Legg Mason. And Rajeev joins us this morning from our Singapore bureau. Welcome, Rajeev, to our program in this year of the tiger. I guess the obvious initial question is people want to know, will this trend continue? Will corporate bonds, especially these junk quality ones, continue to beat out the returns that we're seeing for stocks?
Yeah, I mean, corporate bonds definitely are benefiting from a very positive set of factors, and we think that they will continue these set of factors going into this year. You mentioned the extremely high returns, and your chart showed them last year. Last year, of course, was an exceptional year with a rebound from the previous year. But even looking forward to this year, we think that the returns will be good. The underpinnings are twofold. One, it's global. It's this famous Goldilocks scenario where growth is recovering, but it's not recovering too fast to have the major central banks tighten monetary policy. We don't think that the Fed's going to tighten until very late this year, if at all. We don't think the ECB is going to tighten, and we don't think the Bank of Japan will move towards the upside. If anything, it might loosen further. So with that backdrop, that's extremely good for liquidity into the overall credit markets. Add that the strength that you mentioned as well in Asia, the economic upturn, which is definitely going on and which we think will continue throughout the year, that gives a very good mix for the for high yield as well as investment grade bonds, and the spreads still offer a premium over US and Euro similar quality bonds.
Now, this is what I find interesting, Rajeev, because you're favoring these U.S. dollar-denominated Asian corporate bonds compared to the sovereigns at this point. Why? Because the yield is more compelling to you?
Yes, I mean, the yields are definitely more compelling. In the Asian sovereigns, of course, there are two sectors of the market. One is the domestic local currency bonds, and the other one is the dollar sovereigns. The domestic local currency bonds, which is a far broader market, do offer yields, but, however, they do have the risk of seeing some tighter monetary policy across the region. And we do think that central banks will tighten. A lot is priced in the curve, but it is still a more mixed environment than the one which is definitely favorable for investment grade and high-yielding bonds. In fact, this most recent sell-off in the global risky markets, triggered by the events in Greece and furthered by a couple of other events which hit the risky markets, really gives one, we think, a pretty good entry point to increase positions in investment grade and high yield bonds.
Okay, so I guess there's an upcoming opportunity. This is the opportunity that if you aren't already in these high yielders, in these high yielding corporate bonds, that maybe this is the time to join in. What about those that are already holding these corporate bonds? Should they add to their positions?
Yes, I mean, on weaknesses, we've had a few, brief periods of weakness in the last 3 months, which have given opportunities. The Dubai crisis in early December, late November was one such opportunity, though it was extremely brief. And then the lengthier, crisis that we had coming out of Greece also caused a sell-off in some of these corporate bonds. But other opportunities are the new issue market. We will see new issuance by high yielders as well as by investment grade issuers in the next couple of weeks, we believe. And that should offer investors the opportunity to be able to participate in these new issues, which often will have a new issue discount as well, so allowing you to get in at good levels.
Okay, well, Rajeev, let's break it down then. You mentioned those two groups of high-yielding corporate bonds, also investment-grade corporate bonds. So let's break it down, I guess, by division and start off first with the high-yielders, because some of the high-yielding bonds, the corporate names that you like, include a lot of commodity companies. For instance, we have Indonesian coal producers such as Bumi Resources and Adaro Energy. And you also like bonds of forest products company such as Sino-Forest. So let me just ask you why the bias towards these commodity-related bonds first off.
Well, the upswing that we saw in China based on the government stimulus package almost 15 months ago, which began almost 15 months ago, is still ongoing. Even though there is some slowing of new projects, ongoing projects will continue for a while. And so we think that that infrastructure boost will suck in a lot of imports of energy, such as coal, and that's why we like some of these Indonesian coal companies, and will also be good for lumber, and that's why we like the Sino-Forest issue as well.
Okay, but
we think that the overall macro situation in China is also positive, and even if there's some cooling measures taking place right now, we don't think it'll put the economy at significant risk.